Bitcoin just climbed back above $64,000. It just liquidated hundreds of millions of dollars from the traders who bet against it, and it's up more than 6% on the week. And yet, if you look one layer beneath the surface, something is very wrong. Because at the exact same moment the price is recovering, the crowd is still absolutely terrified, the biggest institutions are still quietly selling, and the chart is flashing a warning pattern that most people staring at the green candles have completely missed. Stop scrolling and stay with me, because this is one of those rare moments where the price is telling you one story and the data underneath is telling you a completely different one, and the gap between those two stories is exactly where fortunes get made and lost. So today I'm going to show you what just happened, why the recovery is real but fragile, the one chart signal that could flip this entire rally on its head, and the exact levels that tell you whether Bitcoin has truly bottomed or whether this is the most convincing trap of the year. Let's get into it. Let me start with the good news, because there's genuinely a lot of it and it matters. Just days ago, on the 1st of July, Bitcoin bottomed out at $57,735, its weakest level in 21 months, the ugly punctuation mark on a June, where it fell roughly 20% and dragged its total losses for 2026 down toward 34%. That was the moment of maximum pain, the moment where conviction breaks and weak hands capitulate. And from that exact low, Bitcoin reversed hard. As of today, it's trading right around $64,000, having pushed as high as $64,476 earlier in the session, up about 0.75% on the day and a full 6.27% on the week. That is a genuine, forceful recovery, not a weak little bounce. And the way it happened is important. As Bitcoin broke back above 62,000, it triggered a wave of short liquidations. Over $450 million in short positions got wiped out on that break, and in the last 24 hours alone, liquidations hit around $160 million, with roughly two-thirds of that ton, over $100 million, coming from shorts versus just $54 million from longs. That short-heavy pattern tells you something clear. This move higher was forcing the bears to cover, to buy back their losing bets, which added fuel to the very rally they were betting against. The people who were certain Bitcoin was going lower got run over. So on the surface, this looks like a clean recovery story. Price up, shorts crushed, momentum building. But here's where it gets fascinating, and here's why I titled this video the way I did. Because underneath that recovery, three things are deeply, strangely out of place, and understanding them is the difference between reacting to the crowd and thinking like the smart money. The first thing that's wrong, and it's the most striking, is the sentiment. You would think that with Bitcoin up 6% on the week and shorts getting liquidated, the mood would be turning optimistic. It's not. The crypto fear and greed index is sitting at 23, which is firmly in extreme fear territory. Let that sink in. The price is climbing and the crowd is still terrified. In fact, just a week or so ago, when Bitcoin was near 58,000, that fear reading dropped as low as 10, near total panic. Now here's why this matters so much, and why experienced investors actually get excited when they see this exact combination. When price rises while sentiment stays buried in extreme fear, it is historically one of the most reliable contrarian setups there is. It means the recovery is not being driven by euphoria, not by retail FOMO, not by people piling in at the top. It's being driven by something quieter and more durable. Sellers becoming exhausted and patient buyers stepping in while everyone else is still too scared to look. Extreme fear at a rising price often marks the moment capitulation is passing and a base is forming. So that first wrong thing, it's actually a hidden bullish signal in disguise. The second thing that's wrong is the institutions. And this one cuts the other way, so pay close attention, because I'm going to give you both sides honestly. Despite the price recovery, the big money is still, on balance, heading for the exits. The US spot, Bitcoin ETFs, BlackRock, Fidelity, all of them, bled a record amount in June, north of $4 billion, the worst month since these funds ever launched. And even with the recovery, the flows are still deeply negative when you zoom out. Over the last 7 days, the ETFs have seen about $1.6 billion in net outflows. Over the last 30 days, it's around $6 billion out the door. There have been some green shoots, a big $221 million inflow day on July 2nd that broke a 10-day outflow streak, and a modest positive flow today of around $46 million. But make no mistake, the broader institutional trend is still negative, with something like 5 positive days versus 25 negative days over the past month. Citi even cut its Bitcoin price target down to $82,000, citing exactly this weak ETF demand. So while retail sentiment is quietly bottoming, the institutions are telling you they're not fully convinced yet. That's a real headwind, and I'm not going to pretend it away. But here's the twist inside the twist, the part that reconciles these two forces. While the ETFs, which represent a lot of that institutional and retail money flowing through regulated products, have been bleeding, the whales and the long-term holders have been doing the exact opposite. According to Bitfinex analysts, the large wallets accumulated more than 270,000 Bitcoin over just 2 weeks, roughly $16.7 billion worth. And Glassnode, the on-chain data firm, confirms that long-term holders have returned to accumulation, with broad-based buying emerging across wallet cohorts. So the picture is genuinely split down the middle. Institutions selling through ETFs, whales and long-term holders quietly buying on-chain. That is exactly the kind of divergence, big money distributing while patient money accumulates, that has historically appeared near market cycle lows. It's not a guarantee, but it's a fingerprint worth respecting. Now, the third thing that's wrong, and this is the one that could genuinely flip this whole rally, is the chart. Because while the price sits at 64,000, the technical structure is flashing a warning. CoinStats has explicitly identified a bear flag forming near 64,800. Let me explain what that means, because it's the single most important pattern on the board right now. A bear flag is a bearish continuation pattern. It forms after a sharp decline, followed by a period where the price drifts sideways or slightly upward in a tight consolidation, the flag. And the danger is that bear flags typically resolve to the downside. If Bitcoin cannot decisively break above that 64,800 to 65,000 zone, then that bear flag stays active, and it points toward downside continuation risk, back toward 58,000, even 55,000. On top of that, the price is trading inside a descending channel, and it's still well below its major moving averages, below the 50-day, below the 200-day, which sit way up in the 71 to 73,000 region. Structurally, on the daily chart, the trend is still bearish until Bitcoin reclaims those higher levels. But, and this is crucial, the chart isn't only bearish. There's also an early, unconfirmed double bottom potentially forming down in that 58 to 60,000 zone. A double bottom is a bullish reversal pattern, two troughs at similar levels signaling that sellers have failed twice to push lower. If that pattern confirms, if Bitcoin holds above 60,000 and starts making higher lows, it would be a genuine sign that a cycle bottom is forming. So the chart is a battleground. Bear flag pointing down, double bottom hitting up, and the resolution comes down to one thing. Can Bitcoin break and hold above 65,000? That's the line that invalidates the bear flag and tips the technical picture bullish. Below it, the warning stays live. So let me pull this all together into what actually matters for you, because this is where you make decisions. The levels are clear. On the upside, the immediate battle is that 64 to 65,000 resistance zone, the exact area where the bear flag lives. A clean, decisive break and hold above 65,000 does two things at once. It kills the bear flag, and it opens the path toward 66, 67,000 and turns this recovery into something much more serious. That's your confirmation level. On the downside, the key support is the 59 to 60,000 zone OS, the base the recent recovery was built on. As long as Bitcoin holds above 60,000 without fresh heavy selling, the recovery structure stays intact and that double bottom thesis stays alive. But if Bitcoin loses 60,000 decisively, the bear flag takes over and a retest of 58, even 55,000 comes right back into play. So write these down, break and hold above 65,000 to confirm the bottom, and treat a loss of 60,000 as your invalidation. Now let me be completely honest with you, because I will never sell you a certainty that doesn't exist. This recovery is real, but it is fragile, and the data itself tells you why. A huge chunk of this move was driven by short covering eyes, by bears being forced to buy back rather than by fresh, aggressive spot demand. And short squeezes have a nasty habit of pushing price up fast, and then fading just as fast once all the trapped shorts are cleared out and there's no more fuel. The funding rates confirm this cautious picture. They're positive but neutral, around 0.0087%, nowhere near the overheated levels that signal a euphoric, crowded long trade. Open interest is rising but stable at around $48 billion. Participation is returning, but not at the frantic pace that usually precedes a massive breakout. So this is not a market ripping higher on unstoppable conviction. This is a market cautiously testing whether it has found a floor. That's why the levels matter so much more than the emotion right now. Let me bring in the macro, because it's the engine underneath everything. The single biggest reason Bitcoin turned around was not a crypto story at all. It was a rates story. The June US jobs report came in weak, with payrolls growing by just 57,000, far below expectations. And in this rate-driven market, weak jobs data is bullish for Bitcoin, because it cuts the odds of the Federal Reserve hiking rates and pulls forward the expectation of easing. High rates have been the boot on Bitcoin's neck all month, so any hint of the Fed loosening its grip sends risk assets higher. On top of that, the Fed chair recently signaled that inflation risks have come down, adding to the relief. Analysts have literally described Bitcoin as trading like a pure rates asset right now, meaning it's moving on macro relief far more than on anything crypto-specific. And there's a geopolitical wildcard in the mix too, with US and Iranian officials in talks, which is the kind of headline that can swing risk sentiment in either direction on any given day. But here's the pivot. The macro that lifted Bitcoin can just as easily sink it. The next US inflation print is the event that matters most. If it comes in soft, it confirms the dovish shift. It gives the institutions a reason to stop selling and start buying, and it could power Bitcoin straight through that 65,000 resistance and kill the bear flag. But if inflation comes in hot, the way it did back in May when it ran at 4.2%, then the rate hike fears come roaring back, the ETF outflows likely accelerate, and the bear flag gets exactly the catalyst it needs to resolve to the downside. Because Bitcoin is trading like a rates asset right now, that inflation number is effectively holding the trigger. Watch it closely. Let me lay out the three scenarios honestly, because I never want you leaving this thinking there's only one possible future. Scenario 1 is the bullish breakout. Inflation cools, ETF outflows finally reverse into sustained inflows, Bitcoin breaks and holds above 65,000, the bear flag is invalidated, the double bottom confirms, and price grinds towards 66, 67,000 and beyond. In this world, that 57,000 low was the exact bottom. The whales who accumulated 16 billion look like geniuses. The extreme fear reading marked the perfect contrarian entry, and the June capitulation is remembered as the great transfer of coins from weak hands to strong. This is the scenario the on-chain accumulation and the contrarian fear reading are quietly pointing toward. Scenario 2 is the messy consolidation. Bitcoin can't quite break 65,000 cleanly, but it also doesn't collapse. It chops sideways in that 60 to 65,000 demand cluster for days or weeks. The bear flag and the double bottom fight it out, and the market grinds while everyone waits for the next macro catalyst. This is actually the most common way durable bottoms form, not with a clean rip, but with a frustrating, patient base that tests everyone's conviction and shakes out the impatient before the real move comes. If you see this, don't panic. It's the bottoming process doing its slow, unglamorous work. Scenario 3 is the one you absolutely have to respect. The bear flag resolves down. Inflation comes in hot, the institutions keep selling, the short squeeze fuel runs dry, Bitcoin fails at 65,000, loses 60,000, and the bear flag plays out toward 58, then 55,000. In this world, the recovery was a relief rally inside a larger downtrend, driven mostly by short covering rather than real demand, and the whales simply bought too early. This is exactly why 60,000 matters so much as your line in the sand, and why that bear flag deserves your respect rather than your dismissal. It tells you which of these three worlds you're actually living in. Now let me talk about the psychology, because this is where most people quietly lose their money, and it ties directly back to that first wrong thing we discussed. Right now the price is up, but the crowd is still terrified. Fear and greed at 23, extreme fear. And on social media, the mood matches. Polls show most traders have some hope it could pump, but are waiting for confirmation above resistance before committing. There's no euphoria, no FOMO, just cautious, guarded hope. Now here's the thing you have to internalize. This is exactly what the environment feels like near a bottom. It never feels safe. It never feels obvious. The whales weren't buying $16 billion because it felt safe. They were buying precisely because everyone else was too scared to. The exact fear that's keeping the crowd on the sidelines is the same fear that created the cheap prices the smart money is scooping up. This is the eternal lesson of every cycle. The money that survives and compounds is the money that can act on a longer time horizon than the fear screaming in its gut, while the money that gets shaken out is the money that waits for it to feel safe, which by the time it does means the easy gains are already gone and you're buying from the very whales who accumulated down here. I'm not telling you to buy. I'm not telling you to sell. I'm not your financial advisor. And Bitcoin is one of the most volatile assets on the planet, fully capable of resolving that bear flag to the downside and making these prices look expensive. What I am telling you is to hold two truths at once, the way the data demands. The recovery is real. 6% on the week, shorts crushed, whales accumulating, sentiment quietly bottoming, macro turning friendlier. And the recovery is fragile, institutions still selling, a bear flag still active, the move partly squeeze-driven, and an inflation print sitting on the trigger. Both things are true at the same time. Your job is not to pick a side emotionally. It's to watch the levels and let the price resolve the tension. Break and hold 65,000, and the bulls win. Lose 60,000, and the bears take over. That's the whole game, laid out in front of you. Let me tie the entire picture together one final time so you walk away seeing the full board. Bitcoin has recovered from a 57,700 low to around 64,000, up 6.27% on the week, liquidating over 450 million in shorts on the break above 62,000. But the picture underneath is split. The bull case. Whales accumulated 270,000 Bitcoin. Long-term holders are buying per Glassnode. Sentiment is stuck in extreme fear at 23, which is a classic contrarian signal. Funding is neutral rather than overheated, and the macro turned friendlier with weak jobs data and dovish Fed comments. The bear case. ETF flows are still deeply negative at minus 6 billion over 30 days. A bear flag is active near 64,800. The price is below its major moving averages. Citi cut its target to 82,000, and much of the bounce was short covering rather than fresh demand. The confirmation is a clean break and hold above 65,000. The invalidation is a decisive loss of 60,000, and the ultimate trigger, sitting right on the horizon with its finger on the button, is the next inflation print. This is not a prediction. This is the map. The price is telling one story, recovery. The data underneath is telling another, caution. And the tension between those two stories resolves at exactly two levels, 65,000 above and 60,000 below. Whichever one breaks first tells you which story was true all along. Now you have every level, every signal, and every piece of the puzzle you need to watch it play out in real time, instead of getting swept up in either the hope of the green candles or the fear of the crowd. If this breakdown gave you more clarity than the noisy headlines did, then you already know exactly what to do so the next one finds you the moment it matters most. Stay sharp out there, watch that 65,000 line, respect that bear flag, protect your capital above everything else, and I'll see you at the very next signal.